And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
24 minutes to 5. Time to welcome along to the studio once again the aforementioned individual, Mr. Luke Smith.
Good afternoon.
From Envision Financial. How's it all going?
Yeah, going good. It's going better after those storms.
I tell you what, the weather today is a whole lot more appealing than it was 2 days ago.
Yeah, and I think the wind is definitely lingering around from some of those. There were some amazing winds the other night, weren't there?
Indeed they were. And it was very hot before the storm struck as well, too. I think we hit about 35 degrees on Wednesday.
Yeah, it was lovely. Yeah.
No, too hot. I'm sorry.
It all went pear-shaped in the afternoon, didn't it?
It really did. Never mind, that's not why we're here. We are, in fact, here to talk about all sorts of financial matters. And today we're talking about something called the total super balance. Now, I thought that was just whatever it is you have in your super. But apparently, it's actually a technical term that has some importance.
Yeah, look, it does. And for a bit of context, the total super balance is the maximum amount of money that you can have and be able to make non-concessional or tax-free contributions. And I just wanted to sort of lay the sort of groundwork here and simplify it the best we can, because I think there's a lot of confusion. And I guess I'm raising it today because people don't consider this, but they think about their ability to contribute and say, well, I'm allowed to put in 120,000 tax-free. Or 360,000, which is a collection of 3 years, which we've spoken about as a non-concessional contribution. What I want to point out to people today is you've got to check your total super balance, because how much you have in super will directly dictate the amount that you can add going forwards.
Okay, so the reason for this is apparently there's a limit to how much you're allowed to have.
Well, there's a limit. Correct. There's a limit on how much you can get in and your ability to contribute.
The powers that be, they just don't want us to get ahead, do they?
No, that's exactly right. Yeah, I think this is absolutely ridiculous, and I think it's just another way of trying to hold money outside of super, so then you could get taxed at your marginal rate, which is more than 15%, so they can spend it on stuff we don't need, but that's another whole show. So 1.9 million is the total super balance, and if you have exceeded that, that means that you cannot, in the majority of situations, and we'll explain one that is exempt, you cannot add money to super. So I've got $2 million in super, let's say, and I win $500,000 of Powerball. And I go, well, I can put in 120,000 or 360,000 in one go as a tax-free contribution. Yes, you can, but you first need to check and say, am I eligible to use that legislation? And that's what I want people to take from today. Am I eligible? Because if you start getting up there and having a very good balance like 1.8, 1.9, the assumption I see is, well, I've got 1.8 million, so I'm less than 1.9, so now I can put in 360,000. No. To be able to put $360,000 into super, you need to have, at 30 June of the year you do it, less than 1.66 million. Okay, now that is the gap between 1.66 million and 1.9. That's your $360,000 gap.
Yeah.
Okay, so if you're under that at 30 June, yes, you can put in 3 years of 120 at 360. If you're between 1.66 and 1.78 million, then you can only do 2 years or 240,000. And if you're over 1.78 million, you can only do the 120,000 of the non-concessional limit. Now, that all sounds a bit gobbledygook. All I want people to take from today is, don't assume just because the law says you can put it in, that it's applicable to you automatically. This is where total super balance comes in.
Okay, so what we're talking about here is making contributions that are tax deductible.
Tax-free.
Oh, sorry, tax-free.
Yep.
Okay. Making contributions that are tax-free. Is it the case then that you can actually put money in, but you just don't get that tax benefit?
So this is another one I want to dispel. Great segue. We're talking about putting money in and not claiming a tax deduction, known as a non-concessional contribution.
Right.
This does not preclude you from the $30,000 limit.
Right.
Where you put in the money and claim a tax deduction either by yourself or by yourself and your employer. But we know that 30,000 is the most that you can put in. One anomaly to this ability to contribute is the downsizer legislation. If you sell your primary home and you are eligible under the terms of the downsizer legislation and you have 1.9 million, you can add 300,000 as there is a specific exemption in the legislation for the downsizer contribution, because it is treated as a different type of contribution to a non-concessional contribution. So when I say you can never do it, never say never, the downsizer is the only exemption that I'm aware of that people can keep in mind, because a lot of their equitable value in the home they may not need if they move to a smaller property and they want to add to their balance, they can do that. The other thing I want to stress is you can keep making your deductible contributions, but you also then want to think about when it's tested. So another big misconception I get is people come in October and they say, oh, I've got 1.49 million. Ooh, I'm okay. I've got lots of room. Great. I have other people that come in and go, I'm at 1.88. I can do it. It's not when you make the contribution. What was your balance at the previous 30 June? So you might have had 1.7 million or 1.8 million at 30 June, and you might have 1.9 million in December. You're still eligible to put it in the next financial year, because it's what did I have in total super, which is accumulation phase, pension phase, and the market value of your defined benefit. So we'll come back to that. It's what you have in total super balance on the 30th of June in the year prior to the time you make the contribution. Now that brings us into a couple of different questions where people go, well, how's it measured? It's recorded by the super funds, it's uploaded to the ATO, and you can get a register of it out of MyGov. You can also then confirm with your superannuation providers as a backup, because I wouldn't always blindly check and agree with what's in MyGov. But that then makes you think, well, if I'm going to sell some assets and I do want to add some money into superannuation, what are some things I could do to make the most of what I have already? One of them could be that leading into 30 June, if you've already met a condition of release, i.e. you're 60 and you can access your super, you might want to pull some money out of your account, put it in tax-free to your spouse's account to bring down your balance leading into 30 June. If you know that you're going to sell an investment property later in the year, you need to be thinking well in advance of 30 June to see, well, where am I on the scale? How much could I put in? And how could I maximise my benefit? One way to maximise it is to make a withdrawal and a recontribution into a spouse's superannuation so that your balance is much lower. So if you did sell a house in November, you know you're under at 30 June, so then you could put the money in from the sale proceeds and bolster up your total super balance. Another way to think about it, and we've touched on this in the past, is to manage the taxable portion of your super so that you can limit the tax impact of your super passing to adult children and paying 17% tax. You might want to do a withdrawal and recontribution strategy prior to 30 June to manage your balance and manage the taxable components. And you might look at that holistically between, say, you and your spouse so that you can get the best outcome possible. Because it's very much about trying to make the most of what you have in super up to that limit. Now, you can also go over the limit and come back. It doesn't mean that once you've hit it, you're gone forever, because you might pull out some money, buy the kids a house. Mm-hmm. Your balance has now come back down. Now you may be eligible to add more money in later. So it's a living, breathing measure.
Forget the house for the kids. Buy yourself a Ferrari.
Well, that too. Might already have a Ferrari. I don't know.
Look, I've got a question here.
Yep.
The total super balance, is that the same thing as the transfer balance cap?
No. Another great point of separation here. And these two get smacked together like peanut butter and jelly, but they test two very, very different things. The transfer balance cap is how much you have in an income stream. It's quite coincidental that at the moment, the transfer balance cap is 1.9 million. The total super balance is 1.9 million. So I understand that people have some confusion around, well, are they the same, but what do they do? Transfer balance cap is how much you have in an income stream, and how much tax-free income you can have in a pension, and anything over the transfer balance cap is deemed an excess amount. Total super balance is more talking about your eligibility to make contributions. Transfer balance cap is how much can I have in a pension that is tax-free.
Right.
So they're two very different things. And people also need to remember that just because your transfer balance cap is 1.9 million today, that doesn't mean that that is the number you're working with, because you could have triggered the transfer balance cap in 2017 at 1.6 million, and that could be your limit. So it's important, again, that people just take from today that you need to separate what they are, you need to separate what they test, and don't assume that just because the legislation says you can put in 120,000 of tax-free money, that you can automatically do it. I always come back and say, what are we trying to achieve? Come back to our why. Why are we going to put the money in? How are we going to put the money in? Can we put the money in? And the can part is metered by what is your total super balance. Can I do it? Transfer balance cap says, can I now start a pension with what's in there? The answer might be yes, the answer might be no. So it's important that people separate it. It's just coincidental that they both have exactly the same balance and often get mushed together as the same thing.
So two different things, even though they coincidentally happen to have the same threshold figure.
Correct.
Yeah,
exactly right.
But it's easily confused, isn't it?
Well, and again, I think it's the introduction of transfer balance cap was really just the reintroduction of what was reasonable benefit limits in the 2000s. So we had that legislation in the past. They just took it away, brought it back, gave it a different name, and thought they'd created a new monster, but it was just the same monster with a different hat on.
Okay, so if we're close to our total super balance, are there any strategies to accommodate that, to try and get some more money in there somehow?
Yeah, so again, that recontribution strategy that I touched on would be a good one, where you then start to think about you and your partner's total super balance, and because it's an individual test, okay? So if you've got a self-managed super fund, it's 1.9 million for me and 1.9 million for you if we were in the same fund. It's not one test between, say, two partners. It's an individual test.
Right.
You might also then look and say, well, what could I hold outside of superannuation and still get tax-free income? Because if you've got no other income over the age of 60, if you draw pension money out of super, it's tax-free. So you could have $800,000 in a family trust, generating $30,000 to $40,000 of dividends, and you could allocate out of the family trust 20 to me and 20 to you. That's still going to be pretty much tax-free. So I don't want people to be concerned about some of these rules, because they're just rules. It's not the end of the world. A lot of people get their undies in a real bunch about transfer balance cap, but it's not the end of the world. And I don't want people to be, not sleeping well at night worrying about this stuff. But I do preface that if you have a defined benefit pension, so in town, CSS, PSS, DFRDB or MSPS, that has a recorded value against your total super balance. So don't make the rookie mistake of going, oh, I've got $1.5 million in this super fund over here, and I've got a $50,000 PSS pension. You need to get the recorded value of that PSS pension, because it will count towards your 1.9, and you don't want to make the assumption that it doesn't just because it's not a lump sum amount. It's given a lump sum value for recording purposes. So remember, total super balance includes all accumulation super and all pension accounts in totality from all sources. So it's important that you check before you start making contributions, because if you are in excess, the penalties are quite severe, and it's just a road you don't need to drive down.
Luke Smith from Envision Financial is with me in the studio today. We're talking about the total super balance. 10 to 5 now. Back with more in just a moment. 7 minutes to 5. Luke Smith from Envision Financial is with me in the studio today. We're talking about what is the total super balance and what does it mean. So what are the key points for people to remember about a total super balance?
Yeah, so one, it's your total accumulated superannuation, either in accumulation phase or in pension phase, including defined benefit income streams, because they are applied or they are given a market value for the purpose of the test.
Yep.
So you need to include all of that and make sure you have your data. Remember that it's not your balance at the time of contribution. This one people get wrong 99.9% of the time. They get all upset and go, oh, I'm over the limit now. Hang on, but what was it at 30 June of the year before? That's when the test applies. What you then do in the next 12 months is completely up to you, regardless of the market value of your account. So remember, it's not when you put the money in, it's what was your balance at 30 June of the year prior. Remember that going over this limit does not preclude you from making deductible contributions. We're only talking about making tax-free or non-concessional contributions to super, which are the 120,000 or 360 in one go for 3 years. You can still make your salary sacrifice, your personal deductible, because that's fine. Think about managing or manipulating your balance. If you know you're going to sell an asset that could be quite lumpy, like an investment property, or you may inherit some money later in the year and you want to add it to super, you want to be thinking about trying to make a withdrawal where you're eligible to do so and adding to a spouse's superannuation where they may have a lesser balance, so that you're then increasing the window of opportunity that you have. And I think the most important thing is that just because you're under 1.9 does not automatically mean that you can put in the full 360,000. There is a tiered eligibility. So if you're under 1.66 million at 30 June, you can do 360,000. Under 1.78, you can do 240. Over 1.78, you can only do 120,000. So again, don't assume just because you're under 1.9 that you can do the full shooting match of 360,000. You want to start by saying, why am I putting it in? Now, how am I going to put it in? And then, can I put it in? And the can is measured by your total super balance. So I think if you just keep those few points in mind, and remember that total super balance is not the same as the transfer balance cap. It is a completely separate test. It just happens to have the same number at the moment.
Indeed, which is what leads a number of people to be a little bit confused about that. But speaking of confusion, I still find all of this very complicated.
Yes.
So, Luke, that's why we have people like you to help us through this minefield.
Well, hopefully we can hold your hand and we can all skip down the yellow brick road together, and just avoid those mistakes. And I guess why I point this out in today's show is don't assume, and just double check your numbers before you go making contributions, because the penalties can be quite significant, and you just don't want to have that on your shoulders, because if I did that, I'd never hear the end of it from my wife.
Well, absolutely. Indeed. So, Luke, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. It's Envision with an E. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra, which is a YouTube channel. So if you subscribe to that, you can get all of the detail that we have from previous shows and watch it on your phone. And it's a specific topic in Smart Money Strategy, your ultimate guide to financial planning, available in all good bookstores, Amazon and Booktopia.
Absolutely. Luke, thank you so much for popping by today. We'll catch you again next Friday.
See you next week.
Luke Smith from Envision Financial will be back with us again at the same time next Friday afternoon with some more financial wisdom and information.